if you think through what the government spends its money on, there's discretionary and non-discretionary. Non-discretionary things that they have to, Social Security, Medicare. The discretionary part of their budget roughly is around 6%.
Yeah.
Defense is half of that. The cost of interest right now is over 3%, meaning we don't really have a balanced budget at all. Like, we have to spend all the money and the interest cost is only going to exert more pressure on it. And this is why the fiscal situation just looks terrible when you play it out. So soapbox, I'm stepping off of it.
Welcome to the Tao of Chao podcast, where we will try to find balance and provide a clearer path forward in this uncertain world. I have two wonderful guests with me today. First is Michael Salm. He is Senior Vice President and Head of Multi-Sector Strategies at Franklin Templeton Fixed Income. He oversees the strategy and positioning of fixed income portfolios. Michael specializes in investment strategies related to mortgages and structured credit products, as well as interest rate and volatility derivatives. He has been in the investment industry since 1989. He earned his Bachelor of Science in Applied Economics and Management from Cornell University. My second guest is Dr. Onsel Gulbiten. She is a Senior Quantitative Research Analyst for Franklin Templeton Fixed Income. She specializes in analyzing macroeconomic, political, financial, and other policy developments in global markets. Onsel is responsible for making directional and relative value interest rate, inflation, and currency recommendations across major economies. In addition, her responsibilities include recommending tactical, overall risk levels, and sector allocations within multi-sector strategies. She's been in the investment industry since 2007. Onsel earned a PhD in economics from the University of Chicago and a Master in Science and Bachelor of Science from the Middle East Technical University in Turkey. And here are Michael and Onsel. Well, hello, Onsel and Michael. Thank you for joining me today on this podcast. Onsel, I know you are professionally, you are the macro economist and geopolitical and all the things that is so relevant now. And I expect you have fantastic job security for the next 2-3 decades. We think these are the themes as we go through, and we will talk about some of them, that is so relevant, so impactful, and so important for people like Michael and myself. So I'd like to, ask you the first question, if that's okay, but I want to always give you a little background before I ask so that we have a framework.
Of course.
So I'm probably older than I look, or maybe I look older than I am, however you want to say it. But I witnessed the October 1987 Black Monday, and then the Asian financial crisis, of course, 1997, the collapse of long-term capital portfolio. I think that was, 1998, right? And then the nothing burger crisis, I call it, of the Y2K crisis. Then the dot-com crash in the 2000. And of course, everybody still remember now the GFC of 2007, 2008, which almost brought down some countries. Then in 2016, the Brexit. And then finally, the global COVID pandemic in 2020. But we're living through these events and the rippling effects at least every 10 years, seems like. Every decade, we have something like never seen before. We just kind of try to anticipate what's going to happen going forward. So as the post-COVID world appears to have normalized, with the global supply chain supposedly fully recovered, there's still question if it is fully recovered. But then the reason we still have questions is because we run smack into the escalating great power competition with China. And also there are two hot wars going on, not to mention the general election of about 64 countries, including the European Union, which represents a combined population of about 49%. That's a lot, Onsel. I mean, just by reading this and thinking about this is a lot.
Right.
Right? Is this time really so different? And how do you think about that? Maybe we should start with that simple question.
Well, uncertainty is always with us. The distribution of uncertainty or events might change, but uncertainty has always been with us and will be with us. So we have to make decisions based on that. While we might have a base case and some probabilities around it, but we also consider, what if it doesn't happen? What if this happens? What if that happens? We have to consider tail risks as well. So we try to think all those possibilities and try to make the best decision out of that.
Let me just do some definition briefly. So first of all, uncertainty, I think, is defined different than risk. Is that uncertainty is we have no idea about what could happen. Risk is that, hey, we know most of the probability of what's going to happen. It's just a matter of what risk we want to take.
Okay.
Uncertainty, we don't even know what's going to happen. So I think the uncertainty it's really the reality. Life is uncertain, right? And number two, the tail risk being basically what you're saying is that talking really more about left tail, we're talking about probability of distribution of outcome, that it is the left tail which is the really, really damaging out there, end of the world type discussion. Those are the things that we worry about, but sometimes there's nothing we can do about. But we're going to go to Michael in a moment because he's the expert in dealing with all these derivatives and stuff that maybe he can help us to cut some of the tail off, and we can talk about that as well. I think you mentioned to me early on that your role in your seat is trying to make the complicated simple, convoluted more easily understandable. So what are some of the things that you would look at with all this confluence of events that you say, here are some ballasts or anchors that I kind of reflect on to think about the uncertainty today?
Right. So key things. What is the US growth doing? What is the global growth doing? What is the policy stance? And obviously how those things are likely to evolve and the interactions between them. These are the key things for financial markets.
So we just had IMF, World Bank gather in my city here in Washington, D.C. The global growth had been ratchet up a little bit because U.S. is ratchet up a little bit. And, so all these little bits. At the same time, I'm hearing the globe is slowing down. So as they are talking about, we're getting a higher projected GDP for 2024 and even a little bit revised upward on 2025, if I recall correctly. There is this whole notion that we may be slowing down in different parts of the world as well. So China certainly is a big contributor, in my opinion, and we don't have to go down that path. That I think a lot of it is cyclical. Certainly there's structural issues, but there are some cyclical events that eventually will get out. But anyway, so they are exporting disinflation potentially.
Right.
But if you look at just the most recent GDP of US, which I think published yesterday, there were some surprises there as well. So can you talk a little bit about all these signals are giving, or people are at least interpreting this signal differently, or noise differently? Let me be even clearer. It's not signal that's different, it's the noise. How do you discern that, and how do you think about that as there are conflicting messages being interpreted?
Well, U.S. growth has been stable at around the same range, even though yesterday's number was a little at the low end. If you look at the underlying growth, personal consumption, especially services, was strong. Some distortions coming from inventory changes and net trade. But underlying growth has been strong at around 2.5%, I would say, in the last 2 years, and is likely to continue. But global growth has been maybe weaker. So that's why we have been talking about this U.S. exceptionalism, because China has been weaker. In the past, China had double-digit growth numbers, have been coming down, now growing at around 5%, but much slower than it used to. European growth just around zero, fluctuating around zero. So there is a really difference between US and the rest of the world. So the global growth slowdown is mostly coming from the rest of the world, while US has been growing at about the same pace and is likely to continue for a while.
So also, I've been saying this for a long time that it's going to be higher for longer because inflation is going to be stickier for
Right.
longer, and the inflation is beyond just the current inflation. I'm talking about even secular and super secular environment for many reasons that perhaps going back to a sub two is not likely, and not likely anytime soon. And even if we get into a recession, that doesn't not necessarily mean inflation is going to be so well contained for a long period of time. That's just me thinking. So you are also, I believe, in the same camp that inflation remains stickier. And how much do you contribute that to sort of a post-COVID changes, if that's indeed one? How much do you consider that? I think all of us, at least maybe you are the exception, but most people, including the Federal Reserve, have underestimated the power of the fiscal transfer, and continuing in some fashion. So is that like eventually going to come to an end? And so it's not until then that the inflation will continue to remain sticky. How much of it you think it's potentially contributed by this reshoring and really starting to think about more manufacturing here, which requires all this additional input that temporarily create a more sustainable higher inflation rate? What are some of the things that you are thinking about?
Okay, the post-COVID environment is really different from the pre-COVID environment. As post GFC, we had especially in US, but in a couple of other countries, we had private sector deleveraging.
Mm-hmm.
That had an impact on inflation and growth, which were on the low side. With COVID and a strong fiscal and monetary stimulus changed the dynamics. It's not just fiscal stimulus. We had strong in the US, one of the biggest stimuluses we had. But on top of that, with a very loose monetary policy, we inflated that. We multiplied the impact of fiscal policy.
Mm-hmm.
So right now, U.S. households have a large, a big. If you look at their wealth relative to incomes, is very elevated.
Mm-hmm.
They have a lot of equities. They have real estate wealth, and they feel rich, and they are willing to spend. This is very different from the post GFC environment. We had just the opposite. People were deleveraging. They weren't willing to spend. So if people are willing to spend, it is a little bit inflationary. It has positive growth effect and positive inflation effect.
Mm-hmm.
Just the opposite of what we had pre-COVID. It was just less inflationary, and it also meant less growth. We are in this environment, but individuals, investors tend to think based on what they experienced. So we have the last 10 to 15 years of history, low interest rates, low inflation, low growth. But dynamics are different. We have higher growth, higher inflation, higher nominal growth.
Mm-hmm.
Fed is worried about, obviously worried about inflation, but also worried about recession. It doesn't seem to go the last mile because there are always concerns. Interest rates are high, some sectors are suffering, that might result in a recession. Nobody likes recession. So little worried, maybe too worried in this new post-COVID environment. And if central bank is not willing to go for the last mile, well, not willingly, but because we have financial stability concerns, we have some sectors doing really badly, and that might result in a recession. If we have a lot of concerns on that, the willingness to go the last mile declines, and inflation might stay a little sticky for a while.
So, Michael, based on all that, I'm still trying to digest all that. I have shared this with you many times that I'm always remember of how you think about the world. Tell us a little bit about the different balance sheets that you have shared with me. This must be 15 years ago, and talk a little bit about your framework based on what we just now talked about.
Yeah, I think you hit the word correctly, framework, and in some ways, going back to how you started with uncertainty. So when you deal with a lot of uncertainty, you need some leveling of, well, how do I compare today's uncertainty with yesterday's uncertainty? Well, there needs to be some consistent framework. And there's a lot of things going on that are different, but if you have a consistent way to apply outcomes, you might be able to skew odds in your favor, which is really what we professionally are paid to do. And why I like having Onsel available is because she has a framework of how these economies and growth and policy all interacts. And when we're thinking about investing in the markets are literally trying to translate all of that uncertainty into a couple of big impulses. And the big impulses, I think Onsel touched on them, are global growth or growth momentum, policy momentum. And then there's a new one, liquidity, which really you have to think about differently because the way the central banks are influencing the capital markets today is just very different than what it was in your black and blue period of 1987.
Yeah.
So for us, that framework starts with the balance sheets. And when we think about an economy, there's 4 different balance sheets. And the balance sheets themselves are, there's the consumer balance sheet, which is a very large because we're a consumption-based economy. There is the non-financial corporate balance sheet. And that is distinguished from the financial corporate balance sheet because they are where the credit channel itself comes directly through that balance sheet. And then there's the government balance sheet. And so when we're thinking about the influence of all these factors and the differences around today versus yesterday, if you kind of play the balance sheets out, you can kind of get some insight on it. And then for us, aligning all of the exceptionalism about what we see today and how you think about if you walk everyone back 3 years and say, what are your forecasts? If the Fed were to raise rates like they did, what would happen? And I think a majority of people, and most of them did, and forecasted, well, that's a recession. There's no way we can go through all that. And a lot of that is just anchoring to behavior that we saw over the last decade. But when you look at the balance sheets and you say to yourself, okay, let's think about those balance sheets. Let's go to the consumer balance sheet. And Onsel mentioned on the wealth for the consumer, their net worth of the consumer as a share of GDP is not at the all-time high because that happened during COVID, during that financial largesse, but it's extraordinarily high. Yeah. And when people feel wealthy, they save less. And so the savings rate's low in the US and consumption's high. And so the asset side of the balance sheet, because of equities and because of housing, is doing gangbusters. And by the way, if you've invested in bonds, you're also getting a much realer coupon rate than you've ever had in your bank account.
Sure.
On the liability side, however, what we've seen is, okay, your largest debt for the consumer is the mortgage loan, and a lot of people refinanced into much lower mortgage rates, and they took out capital because home prices had just done extraordinary. And then it's okay, so then when the Fed raises interest rates, how does that exert, thinking about those 2 balance sheets, where does that really come through? How does that impact the consumer? And because our mortgage rates are just so long, it really does. It's a really slow moving thing. So short-term debt in the consumer balance sheet is just something that's just not used as aggressively as some of these long-term debt. And so from a consumer balance sheet side, we look at it and we say, well, look, assets doing great. Liability costs have gone down. If you look at their financial obligations ratios going all the way back into the 1980s, you'll never see something like what we have. Debt's a little bit higher, but the last decade we delevered a bit. And so the consumer balance sheet's quite strong and employment is good. So going back to our non-financial corporate balance sheets, the employers of the world, their margins also increased during COVID. And because nominally they get from revenues based on inflation's higher, so their nominal growth is also higher. We look at that and say, okay, well, they're doing quite well. Let's go to their liability side. And a lot of the liabilities for them, when you think about the capital structure for corporations, they used to use short-term debt a lot more than they do now. I think the ratio used to be 40% short-term debt to 60% long-term debt. over the last decade plus, they've been shifting it. And then with low rates for so long, they termed their debt out.
Mm-hmm.
And so their cost of debt, while it's increasing now in aggregate, the debt structure of these companies is pretty resilient to where we are today in the Fed funds rate. And so ultimately, their asset side's doing great, consumption's high, people are buying stuff, margins there. Their cost of debt hasn't really changed that much. It's just starting to change. And so when we think about all of this influence through the system of, hey, Fed raised rates, the economy should go into recession, that really is just anchoring to last decade and not thinking through the balance sheets. And when you think about the balance sheets, you're like, well, quite honestly, the exceptional things that we are seeing today behind why can we continue to plow through strong GDP and inflation high, there are a couple of things that are going on that are exceptional, but they're not necessarily long-term exceptional. They're just exceptional today.
Yeah.
Exceptional is we've got a massive amount of net worth on the consumer balance sheet. We've never seen it like this during this phase of a cycle. Exceptional was immigration over the last couple of years in the US has been exceptionally strong versus the trend that we were on. That's exceptional. Don't know if we're going to see that in the long run. The fiscal spending that we're seeing from the government balance sheet during a phase where it's non-war, non-recession, exceptional.
Yeah.
Do you think that that's going to be there forever? Absent war, like there's a defense issue that we have to all deal with in terms of thinking about how the geopolitics play out. So certainly that's a thing to consider, but it's exceptional that they're doing what they're doing with it. And then the balance sheets, how they're structured versus the debt. So I kind of like try to think of this world and going through we used to think in these terms of what's sustainable or what's this equilibrium interest rate or R star, whatever that weird concept is. I think you need to break that into two dimensions now. There is today, I think, a short-term version of R star, which is what sustainable interest rate can the economy take, is certainly much higher because of those uniquely exceptional things that are going on in the system. That's why we can continue to have strong growth and its influence on inflation, and why policy is not necessarily going to give you the cuts that everyone thought that they were going to get in the beginning of the year, because it's unwarranted given the states of those balance sheets. In the long run, we can have a bigger debate about, is it sustainable over the long run? And I think that some of the forecasting errors are using some of those long run views to drive short-term policy when the economy is just really living off the short run. That's kind of how we think about it.
Interesting. Let's spend just a bit of time on liquidity. So far, I think in December press conference, Chair Powell signaled that, hey, we're going to talk about ample reserve. Then came March, he didn't talk much about it. He said, we're thinking about it. So he kind of dialed it back and not really telling us. Certainly, we're not going back to the sub 1 trillion day before GFC. But obviously, we're already down 1.3 or 1.4 trillion from the high. But they are signaling, saying, well, we are getting close to the end of QT. I don't know what that really means. So let's say they chop up 2 trillion, not 1.4, 1.5. Let's say 2 trillion before they stop. That is still something like $6 trillion, just using basic math, or more than 6 or something like that, and which is still 5 trillion or 6 trillion more than before GFC. The world is a different place. Demand for US dollar and bonds and all the other thing is different, of course. How does that affect, or does it at all impact? So that's one question in your mind, Michael. So that's one that I'm concerned about, or maybe I shouldn't be concerned about. And then there is this reverse repo that they're talking about. Maybe we don't need to do reverse repo, which affects how banks make money and all that. Point one. Point two, just to throw it in, shadow banking system, was birthed significantly the way we know today because of GFC. And as you know well, we're not going to talk much about private market, but certainly we cannot ignore the existence of, even though they're only about 1.5 trillion so far in middle market lending. And I think that is not the end, but the beginning of the trend. that is not something that the Fed necessarily control through any kind of mechanism. And I don't believe there is a bubble, because I think it's a misunderstanding of the market itself to consider that as a bubble. So there is still liquidity there, maybe a more expensive liquidity, but there is liquidity. We can no longer just look at banking, which is where you were talking about, but really a wider financial institution, which includes shadow banking system. How do you think about those two things affect, or positively, negatively, as you think about balance sheet and liquidity?
I think it's really important to define liquidity, because there's a lot of different forms of liquidity in the system, right? And so the area that you're talking about from the Fed standpoint is a stock issue with the amount of debt in the system versus reserves in the system, right? So that's a form of liquidity. And then there's the liquidity that sits within the financial system itself, so bank deposits themselves. And so we'll slightly differentiate the private credit stuff from the bank credit stuff, because ultimately, if I'm financing companies through a private channel, I'm not necessarily creating money. And money is really the engine of growth in the economy. It's just a different form of capital at a different cost of capital. And perhaps I'm removing some volatility from risky assets that kind of make the system seem a little bit safer, right? So there's some elements of that. Then there's the additional market liquidity, which is the things that we have to, when we're moving risk around the markets, how do we think about it? So going back to your reserve question, what's ample reserves? We don't know. Mm-hmm. I think if we go back to 2018 and 19, what we realized was, as the Fed was draining reserves from the system, because reserves allow leverage in the system. So things like repo rates and treasuries are all supported by a form of leverage. If that market starts to break, and going back to 08, like the big issue about 08 was when we deleveraged so quickly without a lot of balance sheet to absorb the capital, assets reprice very aggressively. So you want to avoid deleveraging, at least at a very sharp level that we saw in 08. So the safest assets back then were starting to, the repo markets themselves were starting to say, hey, look, I can't borrow enough money here to support all the system. We've got a problem. And so the Fed addressed it back then. And so they're very conscious around, okay, knowing what we know about QT from before, if we do that now, we want to avoid that problem. And the way they look at the problem, and I think this is why they raised their voice beginning of this year, is they look at the distribution of repo rates in the system, and they looked at the tail, and the tail started to show some distress. Now, this is during the year end, so there's always some balance sheet stuff that goes on with year ends as banks try to pretty themselves up for whatever their capital ratio that they have to deal with. Since then, we have not seen any of it again. And so the discussions around what's ample reserves, and I know that they're talking about it, it doesn't seem to be showing up in the data right now in terms of, do we need to consider ample reserves? But they are still talking about QT, and maybe the end of the year gave them just enough of a canary in the coal mine warning that they should be doing this. I think Onsel probably has a slightly more conspiratorial view around why they want to do QT right now, but we'll stick with my narrative for now. And so, we're worried about it, but ultimately, it's just another balance sheet holding assets, and that's an important thing for market liquidity, without question. Yeah. Now, the reverse repo program that they have in place, so there are other ways. So credit is created when money enters in the economy and it hits into the banking system. That flows somewhere, and it stays within the banking system. I may buy an asset from you. You take the money and you put it back in the banking system. So when we watch money in the system, it's really important to understand that even though we may share or exchange things, looking at what the total amount of money in the system is kind of a good indicator of growth impulse in the system. And there are some shadow versions of those. The Fed's reverse repo program is locking up capital away from the banking system, and it's not allowing it to be used for economic growth. Yeah. As drain that money ends up back into the banking system, it's stimulative. The same with the Treasury's general account, the TGA, which Yellen controls. And so the balances within the TGA have been growing tremendously again now that they've got their budgets worked out so far until the next crisis. But it's like 800 billion. It's a lot of money that could enter the system if they ever need to stimulate. If they push that money back into the system, it'll end up in the banking system, and it's another form of stimulus. And so there's a lot of different ways, the channels by which they can continuously apply their policy that's not the traditional banking system channel or the Fed channel. It's, I've got this TGA, I've got this reverse repo program, and I've got the Fed balance sheet. And all those things are working in a way that you need to think about those as they change their posture in those. What is it doing to the amount of capital in the system? That capital will find a home in financial assets. And the financial assets, if the more money you have chasing financial assets, the lower the valuations, or I'm sorry, the richer the valuations are for that. And that's how we think about it. But I don't know if Onsel, if you have a different view of, or
no. Well, as you said, there are three main things. One, the Fed's balance sheet. It has been coming down, but still high, still higher than pre-COVID levels. It has been coming down. But there are two other things working in different directions. One is reverse repo window, as Mike said. If they decline, liquidity comes into the system. And the same way for the Treasury's general account. If it declines, liquidity comes to system. So even though Fed has been doing quantitative tightening, reducing its balance sheet, still Treasury's general account rose recently because of tax payments. But if they come down and reverse repo window, the amount put at that window declines, liquidity comes in the system. So liquidity may not decline, maybe stays flat for a while. Why is it important? Because assets are guided by the amount of liquidity in the system. If it declines, asset values tend to decline. They are like, liquidity is like an anchor. It anchors the asset values. We might deviate from that anchor, but if liquidity declines, the pressure is lower for asset values. Or if liquidity increases, asset values tend to rise.
Yeah, just more juice in the system, so almost, right, Mike?
Yeah.
So also from a global flow of liquidity, not just U.S. Of course, U.S. is the big daddy of all daddies. I mean, there's no question. How is the rest of the world dealing with liquidity, and how much of that is really U.S. centric? Does it add or detract from the conversation we're having? Because we tend to be very, like any country, we are very domicile specific to our own country bias. And U.S., it's fine to be biased U.S. because it's such a big, important player in the financial system. But how's the rest of the world doing in that regard?
Well, U.S. financial markets dominate, really. U.S. liquidity dominates, really. Mm-hmm. In Europe, they have been doing quantitative tightening as well. Yeah. In the UK and various countries have been doing, but still balance sheets are larger than before. Yeah. Declining, but at a slow pace, still higher than before. And in the meantime, BOJ's balance sheet still has been rising, huge and rising.
Interesting.
And they are trying to control the rise in interest rates.
Yeah.
And in this divergence interest rates, they unfortunately have to buy more to maintain rates in a comfortable range.
Buy their own stuff.
Yes.
Yeah, to stabilize. So
yes,
there was some talk about divergence, which is the word you just repeated, about all the central banks are not all going to move in lockstep anymore. We were going through lockstep for, financial crisis. Of course, global financial crisis, we're doing lockstep. Almost all the central banks are, on the same path. Then COVID comes, they're all on the same path. And now, in theory, COVID is over and we're recovering, we're normalizing. And there are different rates. EM is at a very different place than DM, and within DM, and I mean developed market vis-a-vis emerging market, the rate of change and the speed of change and the timing of change seems to be all not in lockstep anymore. As most folks suggest that the EU will be next to cut before the Fed,
Right.
and UK will cut before the Fed potentially, and then Fed will cut depending on when Fed cuts. But they're not like all waiting for the Fed. Well, I'm not going to do anything. I'm going to sit on my hands until Fed, you do something, then I will follow you. You know, that kind of thing. If indeed that's true, I believe some of it is already happening. Switzerland already one of the first to cut rates and so on.
Various EM countries cut.
Right, exactly. EM country was anticipating this all happening, so they raised it way high, and now they're cutting. But it's all relative value, because at the end, also we have to think about currency, right? We have to think about, as you cut rate, your currency or your country stuff is a relatively little bit less attractive than the stuff that in other countries who haven't cut rate, you know, that kind of the carry trade and all the other things that we can kind of deal with. But how do you think about it now during this period of uncertainty of who is going to cut rates and how that's going to affect investing in those countries with a strong US dollar? And how do they deal with it, both from a trade and as well as from an investment standpoint? I know it's a big question.
Yeah, it's a big question. Maybe let's differentiate between growth and inflation. When we talk about inflation, interest rates, we talk about nominal interest rates, but it has a real component and inflation component.
Yes.
So there's a divergence in terms of growth, really, between US and other major economies.
Yes.
As we talked earlier, European growth is just around zero, fluctuating around zero, while we have something around 2.5. And that is likely to stay. The reason is, again, we have high levels of wealth.
Yeah.
And that is supporting consumption, while Eurozone doesn't, or UK doesn't. So there's a divergence in growth. On inflation, more or less everyone experienced a surge in inflation, supply chain issues, food and energy issues, and they have been coming down. Almost lockstep, maybe a little later in Europe, in various countries, but the disinflationary forces has come from the normalization of supply chains, which resulted in decline in goods inflation, and any shocks related to food and energy mostly dissipated. But services inflation, even in Europe, is pretty sticky. Still, there's some disinflationary forces in Europe as well, but will services inflation come down enough? I don't know. Their labor market is tight as well. Despite growth fluctuating around zero, we haven't seen any negative impact on labor market. But because of this growth differential, and Europe is still more vulnerable to shocks, they will be cutting.
They will be cutting.
But will they cut as much as the market expects, or will they start worrying about the stickiness in services inflation? We don't know. So
that's the risk.
Yes, that is a risk.
And it wasn't like if you going back to the Fed pivot, you think about inflation wasn't at their target. It was just coming down in a way that they felt confident that they were going to get to their target. And they shifted to growth as anticipatory. Our policy is now going to protect growth. And so growth became the focus for everybody. Yeah. And some of it kind of makes sense. Like the tool sets they have today, given where debt is, like usually when you get into a recession, the Fed can help and fiscal policy can help. But given where the balance sheets of the governments are, it's just less likely or less powerful of help where we are fiscally. And so I think the central bankers may be becoming more risk managers on the growth side than they were inflation, because they always think that they can handle inflation, except for that narrative got tripped up over the last couple months because of the things that we mentioned earlier about, hey, consumption's really high and the consumer's still doing pretty good, and you can see it in various forms of inflation. And so now I think the markets are wrestling with this. The Fed's focus is turning back to inflation. You can hear it now in all the narrative from all the Fed governors. Yes, this is why we need to be slower than we thought we would be, or just questions around should we be cutting. But it is it's an interesting dynamic how their policy had geared toward cutting rates. And it's not that growth itself, or we were into a recession. It's just that they didn't want a recession, and everyone wanted the soft landings in the way that we're just harder and harder to see where how these are going to play out over the next couple months. But
sure. So on we're sitting here in April 2024, based on the conversation and the balance sheet that you talked about, which make so much sense. And I always try to relearn and relearn and relearn so that I can see it as clearly as you can. Where are you focusing? For example, if there is continued QT, the Fed has always been uncomfortable in mortgages. I mean, they're going to get, not reinvest. They don't reinvest that, but they are very comfortable with treasuries. But yet, on the other hand, mortgages are wonderful. I mean, just as good as treasury because it's backed by the U.S. government and it's going to always give you a little bit higher interest rate, whatever risk that comes with it. What are some of the themes that you are looking at now, Michael? I know you run a huge amount of money on all kinds of mandates. But just sort of thinking out loud, what are some of the things that you are more favorable without naming any product? That's not where I'm going. I'm just thinking, thinking wise, what are some of the things that kind of get you saying, on a relative value standpoint, you may make money, but here just seems more makes sense. Can you share some of that thought with us?
Yeah, I'll try to stay as high as I can on this.
Yes, please.
So going back to our balance sheet discussion, so risk is very low, or the balance sheets themselves are strong, generally speaking, even the financial balance sheets, because there's still some more regulation in the pipeline that we have to think about how it will impact financial market liquidity.
Yeah, the end game thing. Yeah,
the end game. Yeah, that's pretty big, actually. It's really big. But from the household side, mortgages themselves, most of it is underwritten to very strong hands at this point. So after the GFC, the underwriting standards changed meaningfully. And so those people who have a mortgage actually are, from a credit quality standpoint, materially stronger than they were prior. And so generally you're dealing with a stronger cohort of borrowers, and the product mix got safer as well. So we weren't doing the pay option ARMs, we're all 30-year fixed. And so generally speaking, mortgages are good. The problem is it's a big asset class.
Yeah.
And then when you think about the constituents who buy that asset, the Fed was a net large buyer relative to the supply in the market, and they're stepping back. Now, QT itself, as they reduce their balance sheet, they have more control over treasuries. They're looking for prepayments to do the work on the mortgage side, but the prepayments are slower. So in essence, their mortgage ratio is growing just because of the way that QT oddly worked with prepayments. But regardless, they're no longer, and they don't want to be in the mortgage balance sheet game. They want to be in the treasury balance sheet game. They'll figure that out over time. But then that has to land somewhere else in the system. Now, we relied a lot on reserve managers' demand or foreign demand for U.S. assets.
Yes.
Both of those are going to change here. Japan, we have to keep watching because a large amount of savings is sitting in a variety of these economies, holding some of our debt. If they ever repatriate it, or if there's some policy that incentivizes them to repatriate it, we have to absorb that capital back onto our balance sheets. Where does that go in the financial market? So the mortgage market generally safe, except for there's a supply demand thing that you just got to work yourself through here. That that's something to work. But valuations generally are okay. On the corporate balance sheet side, again, generally okay. There are some issues you can see in tails of various things, but pretty good. Debt a little bit higher. Interest rate coverage ratios are also really high, but valuations are really tight. Somewhat reflective of the economy's good. We're going to get a soft landing, and my balance sheet's strong enough. I'm not really worried about us falling into a big problem there, except for your spread as a share of your leverage, for instance, as a measure of fair value, that's really low. Mm-hmm. And so there's a problem there. And now some of that is also confounded by when you look at the absolute level of yields in the market, they're so much higher than we've seen in so long that it's still an attractive outright yield relative to what people anchored to over the last 15 years. And so there's a game of spreads are tight, balance sheets are good, valuations are tight, but absolute yields are high. In those instances, the distribution of outcomes skews. If we get a problem, they're going to go much wider. Can they go much tighter? Yeah, they can, but it's hard, but they can. And so the distribution is negative from a long-term perspective. You play the game of, okay, let's shorten my spread duration and increase my carry on the front end, because the front end has high yields ultimately. And so the way we think about that is, okay, the risk reward is shorter spread duration. So if spreads blow out, you're protected, but you can get the carry from the safe balance sheets today. And then the government balance sheet is just so hard to deal with here. The supply that they're creating, because the deficits are insane, and they're going to only get worse.
Yeah.
And the private sector, so again, going back to our reserve managers, their demand is not the same, or they're not increasing it. They're likely to decrease it. And they're adding more treasuries to the balance sheets of central banks, gets harder and harder everywhere globally. That means the private sector, who are price sensitive, has to start doing some work, and it'll start to displace things. And so for me, it's more I worry about the supply of treasuries, how that impacts ultimate valuations, because that money has to, the issuance that we're going to see there, and we're going to see a lot, has to get absorbed somewhere. And so there's, it's a safe asset. It's just a supply demand problem. So mortgages look good in certain ways. I mean, there's some commercial real estate you got to deal with if you know how to. Treasuries, supply demand problem. And then with corporates, it's more of a valuation asymmetry. And so then there are themes within all of those markets that you can play. And so that's where we sit. So we try to keep our spread risk low, where we think we don't get the right distributional outcomes for long term. And then we just play themes within the different sectors that we think give us the right risk reward from a carry perspective.
That's why I think, and this is not a joke, that's why we need active management in fixed income. We really do. A index just not, the index cannot think through all that. And active manager.
The index is going to be only treasuries at some point here.
Yeah, exactly. So last question, I think I just got started, and I looked at this clock and I said, wow, it's already, time. So Onsel, maybe I'll turn to you. We're not going to get into this R-style discussion. It's just too much, and most audience would just totally lost. They will, what do you think when we talk about higher for longer? A lot of people think of just the last 15 years comparison, but that's really the wrong baseline, the anchor to think about the relativeness. I think we really should be going back to the 80s and 90s kind of environment rather than the 2000 plus environment. So if it is higher for longer, the amount of drop from where we are in interest rate to where we will stop dropping, it's much narrower than what the market at one time anticipated.
Correct.
And maybe still anticipate. Mm-hmm. Is that a global environment or just really a U.S. environment?
Well, if U.S. rates stay higher than they used to, globally we will have to adjust to higher rates elsewhere. Maybe they are going to be lower than U.S. rates, but they are not likely to go back to levels they were before. This is true for Europe, even for Japan, and especially for emerging market countries, because many of them have current account deficits. They rely on capital inflows. In this environment, they are likely to get less capital inflows, and in order to encourage flows, they will have to maintain rates higher. Mm-hmm.
So we are going to a global higher rate environment, or maintaining the higher rate environment for much longer. The other thing that I'm hearing from not necessarily Michael, but people similarly situated as Michael is like, this is, golden era for fixed income. We are at a starting much higher yield and blah, blah, blah. It just goes on and on and on, how great this is the time. Give us all your money. Well, self-servingly, give us all your money because we think that, fixed income is the golden era, is going to be better than stocks. I mean, look at how much it's paying, it's higher than dividend, just all the things that we hear about. What I also understand is that investors tend to jump to where the puck is going. So a lot of people, if they thought that, long-term rate is going to come down, they buy it now in hope for get total return and getting that bump. But at the same time, we're not coming down as much. I'm questioning this thesis, not that in the next 20 years, we're not going to, if we hold a 5% bond, we're not going to make some capital gains, sure. But to what extent and at what risk? What's your thought on that, Onsel? or maybe Michael, both of you. I mean, I think that's one thing that kind of I struggle a little bit. And as I listen to Michael, where I happen to also agree, is the front end of the curve, of yield curve, give me more optionality than the belly or even longer. But on the other hand, the longer side, if indeed I think we cross over a interesting threshold, the interest service by the federal government is higher. We just cross over than the federal defense budget. And you know how much we like federal defense budget in this country, right? So that is a telltale sign. Say, well, hold on, what's happening? So I know Michael has a thought on this. We are thinking the longer end. We haven't seen the high and the longer end,
Right.
So this may not be the time to be jumping in and say, wow, this is the nirvana.
Curve is still inverted.
Yeah.
Yeah. Okay. So maybe we really should be at the 1 to 3 or 3.5, 4 year duration and really buy our time to observe before we say this is the beginning of the greatest time ever. Michael?
Yeah. Two thoughts. Going back to your point on the budget, just because I like this. If you think through what the government spends its money on, there's discretionary and non-discretionary. Non-discretionary things that they have to, Social Security, Medicare. The discretionary part of their budget roughly is around 6%.
Yeah.
Defense is half of that. Our interest, which we're not going, defense isn't really discretionary. It is, but it isn't. So that means that there's like 3% that they really can play with. The cost of interest right now is over 3%, meaning we don't really have a balanced budget at all. Like we have to spend all the money and the interest cost is only going to exert more pressure on it. And this is why the fiscal situation just looks terrible when you play it out. So separate soapbox, I'm stepping off of it.
Yes.
Onsel pointed this out, and I think she might be right on this. So if you go back to post-GFC, we struggled as a market with the very low rates, which were the right trade eventually for that decade, because we kept looking back at the 90s and 2000s saying rates can't be this low. That's a problem. And we kept trying to get rates higher only to come back down, only to come back down, only to come back down. We might be playing the reverse of that now, which is people expect that rates are going to go lower because we convinced ourselves the new normal was a permanent feature in the system.
Yes.
And so we may get these episodes. I think what you're pointing out is the market tries to rally, expectations try to rally, and then we realize, well, gosh, things are stronger and policy isn't going to cooperate. And so we jump back up and then we try to rally and we try to rally. Look at what the VIX is doing. VIX is rising again as interest rates rise, despite the fact that economic conditions kind of still look pretty good. Yeah. It's really just, I don't believe it. Eventually, we may convert people over time. Stick with the balance sheet here, the short-term exceptional things that are driving the balance sheet today. Those are going to persist for a couple years. And then we have to really think about long term. Then we can really think about should rates be lower then. But for the next couple of years, it's pretty resilient.
Michael, just because you say next couple of years, I'm not going to not invite you back for two years to ask you if we got it right. I really, really enjoyed this conversation. I have learned a whole bunch, and certainly thank you, Michael, and thank you, Onsel, for all your insight. And one thing I feel a little bit more comfortable that I'm not the only one feeling uncertain, that I'm not the outlier, and that there is so much going on, and we are so comforted by professionals like you. At least we can look to give us some answers and how you look at the world, at least try to give us an explanation that we can begin to start digesting and think for ourselves.
We need to ask a lot of questions, which is what you're doing and what we do all the time. We are still working really hard to understand the uncertainty, and that's just the professional role that we play.
Again, thank you so much, and I really, really enjoyed our conversation, and I think this conversation goes on because, again, in the uncertain world, I think we're going to get more uncertain with geopolitical aspect as well. So I'm going to tap into Onsel as she gets more sleepless nights as we go through the election cycle, and we'll see what happens. So thank you very much for joining me. I look forward to speaking with you again.
Thank you, Philip. Thanks.
Thank you for having us.
Thank you. You can always find more episodes by visiting philipchow.us/podcast or find us on your favorite podcast app. You can always leave us feedback, ask questions, or request a topic for us to discuss by sending an email to pc@philipchow.us.
Views expressed in the Tao of Chao podcast are individual opinions, and they do not represent the employers of each guest or the firm each guest is associated. Our podcasts are for educational and informational purposes only and should not be deemed or viewed as investment advice or recommendations. Please consult your personal financial advisor, investment expert, or investment fiduciary before taking any actions about your plan and investments.